Hello my dear fellow valuers. So today we are going to start our session with examples and case studies on income approach to valuation. In our last session we had discussed about concepts and theories of income approach to valuation. So let's get started. So all these topics we have already discussed in session 1, which was the previous session. Link is given in the description box below. So today we will discuss 11 examples and 2 case studies on various concepts discussed till today. So let's go through the first example. A freehold site is rented out for 99 years to a developer at a ground rent of 2 lakh rupees per annum net of outgoing. It is renewable. The lease developer has constructed a building fetching an annual rent of rupees 10 lakh. Value the freeholder's interest assuming yield of 5%. So we have to calculate valuation of the freeholder's interest. So whenever we get a question in IBBI, always remember the examiner may give us certain information which may not be required for solving the problem, number one, and he may ask you some information by changing the word, twisting the words. So here the examiner has asked freeholder's interest. However, it is something else. Let us see what exactly it is. So whenever we try to solve an example, any numerical in the exam, always make an habit to first write down the data which has been given by the examiner in the question, in the chronicle order preferably. So first of all, always write down all data. So as per question, lease period is 99 years, so it is perpetual. Net ground rent is 2 lakh rupees per annum. It is important whether it is per month or per annum. Then lease rent of building is rupees 10 lakh per annum. Again it is given annual figure. Then yield 5% has been given. So freeholders interest we have to calculate. So here please pause the video and try to solve the problem of your own. Solution is given on the next slide. So if you see the solution, net annual income earned by landlord is 2 lakh rupees per annum. It is already given in the question. Expected yield is 5%. So since it is a perpetual income, so formula for calculating the landlord interest, lessor, it is a leasehold property. So lessor interest or landlord interest, freeholders interest is net ground rent divided by expected yield. So it comes to rupees 40 lakhs. So this is the answer. Next question is calculate value of freeholder interest of a shop which has been let out for a rent of 2 lakh rupees per month. The rent is renewable and expected yield is 5%. So in previous case it was given 2 lakh rupees per annum. Now it is given 2 lakh rupees per month. So you have to always remember, you have to see whether the rent has been given on monthly basis or annual basis. Again write down data. Net rent 2 lakh rupees per month, not per annum. So we have to multiply this rent with 12 to arrive at the annual ground rent, to annual rent. Since lease period is not mentioned, it is mentioned that it is renewable, so we can presume it as perpetual. Whenever renewable period is mentioned, so always assume it as perpetual lease, and yield given in the question is 5%. So we have to calculate freeholders interest. What is it? Same formula we will use. First we will calculate annual rent of the property, 12 month into monthly rent, which is 2 lakh rupees, so 24 lakh is the annual rent. Then landlord or lessor or freeholders interest is equal to net annual rent divided by expected yield, which is 24 lakh divided by 0.05. So 480 lakh is the answer. Next question, an industrial corporation has decided to lease 20,000 square feet plot for one user for 60-year period. The land rate is 4,000 rupees per square feet. Assuming an yield of 6%, what will be the monthly lease? So here we have to calculate monthly lease rental assuming a yield of 6%. All the data has been given in the question. So what data has been given? First of all, land area has been given, lease period 60 years is given, land rate is given, and expected yield is given. We have to calculate monthly rent. Since we have been given land value and expected yield, we can calculate annual lease rent through accurate method and approximate method. So we'll discuss both the methods. Both methods give nearby actual nearby figure. So if options given in the question are very close, then you should always go ahead with accurate method. If options given in the questions are not very close and wide gap is there, then you may go ahead with approximate method to quickly calculate the answer of this question. So in a graphical form, if we'll see, the lease period is 60 years, and every year, at the end of every year, the lessor will get annual rent of A. First year, second year, third year, and likewise 59, 60 years. So every 60 years, every year for 60 years, he will get annual rent of A rupees. Say. So what is the plot value? So plot value is present value of annual rent. So as we have already discussed in previous sessions, then that means whatever ground rent we are going to get from the plot, that is the if we calculate capital present value or capitalized value of the annual rent that we are going to receive from the plot. So plot value, land area is land rate. Both things are given 20,000 rupees, 20,000 square feet into 4,000 rupees per square feet. So total land value is rupees 800 lakhs, 8 crore rupees. Now, if we calculate present value of the annual rent, in previous slide we assumed annual rent of A. So this formula we know, already know, we have discussed in previous sessions. So present value of annual rent will be A into year purchase formula is this. So if we put 0.066% of yield and 60 years of time period, it will give us a year purchase of 16.16. So annual rent will be equal to 800 lakhs divided by year purchase 16.16. So annual rent of 49 lakh 50,000 rupees per annum. So if we divide annual rent divided by 12, we will get monthly rent of 4.12 lakh rupees per month. Let us see how can we calculate this monthly rent through an approximate method also. So this is approximate method. So in previous case we had calculated year purchase for 60 years. In last session we had discussed that if the remaining lease period is more than 50 years, say, so we can reasonably presume that we can use the formula of perpetual lease also. So if we assume perpetual lease of this property, then property value will be net annual rent divided by R, which is capitalization rate. So A divided by R. So 800 lakhs is equal to A divided by yield or R or capitalization rate, which is same thing. So annual rent is 800 lakhs into yield or capitalization rate or R, 0.06 or IC. Both are all terminologies are same thing, right? So 48 lakh rupees per annum is the annual rent through the approximation method. So monthly rent will be 48 lakh divided by 12 is equal to 4 lakhs per month. Next example is a private trust had leased 5,000 square feet of plot for 99 years lease, which can be renewed for further period. Fixed net monthly lease rent if land rate is 3,000 rupees per square feet. Assume lease rent as 8%. So here again we have to find out the monthly lease rent for the property which is given on the lease by a private trust for 99 years. So again, data given in this question is that land area, land rate. From these two figures we can calculate land value. The lease period is mentioned as 99 years, so it is presumed as perpetual lease. And lease rent, so instead of yield, here the examiner has used the word lease rent is 8%. So expected yield is RC or R or IC. It is one and same thing. So monthly rent we have to calculate like in this last question. So land value is equal to net annual rent divided by R or IC or capitalization rate or yield, whatever. So land value 5,000 square feet into 3,000 per square feet, 150 lakh rupees is the equal to land value. So land value is equal to A annual rent divided by yield. So with this formula, annual rent is equal to 150 into 0.08. So 12 lakh rupees is the per annum is the annual rent for the property divided by 12. It gives us monthly rent of 1 lakh rupees per month for the property. Next question is, a lessor leased his 3,000 square feet of land to a lessee for 99 years on a monthly rent of rupees 1,500 per month. Lease is renewable. On this land, the lessee has constructed a residential building and rented out on total rent of rupees 6,500 per month. All outgoings are 30% of rental income. Calculate lessor interest assuming yield of 5% and lessee interest assuming yield of 7%. So first of all, we will write out the data. Land area, which is 3,000 square feet. Lease period is 99 years, thus it is perpetual. Ground rent is 1500 rupees per month. So always remember that it is given per month, so we have to convert it into annual. Multiply it with 12 to arrive at annual ground rent. Total rent of the property is 6500 per month, so we have to again multiply it with 12. Total outgoings are 30% of total rent, and the yield is 5% for lessor and 7% for lessee, and we have to calculate lessor interest and lessee interest in the property. So we will see this land area is not required in the question. This data has been given just to confuse the IBBI aspirants. We'll see. The solution is the lessor is entitled to receive monthly ground rent from the lessee. So lessor, if you remember in the last session, we had discussed about what are the things, what are the rights which can be valued for lessor and what are the rights which can be valued for lessee also. So in this case, the lessor is entitled to receive the monthly ground rent of rupees 1500 rupees per month, and that means annual ground rent of 12 into 1500, it is 18,000 rupees per annum of annual ground rent. Since the lease is perpetual, so land value for the lessor is annual ground rent divided by capitalization rate for lessor or yield for lessor, which is 5%. So 18,000 divided by 0.05 equal to 3,60,000 rupees. So this is the value of lessor interest in the property. Now next is lessee's interest. The lessee shall receive monthly total rent of 6,500 rupees from the property and pay 40% of total rent as outgoing and rupees 1,500 rupees as ground rent. So if you remember the concept of profit rent, so that will be the profit rent. So thus net annual rent to be received by lessee shall be equal to monthly gross total rent. So per month lessee will receive 6,500 rupees of the rent from the property, out of which, so that means annual ground rent and annual total rent of the property will be 12 into 6,500, that is 78,000 rupees he will receive annually from the total rent, from the property total rent. Less 30% is outgoings that he has to pay. So 30% of 78,000 is 23,400, and less annual ground rent which lessee has to pay to the lessor. So 18,000 rupees he will pay as a ground rent to the lessor. So net annual income of the lessee is 36,600. Since it is a perpetual lease, so net annual income divided by R or capitalization rate for lessee, which is 7%. So 36,600 divided by 0.07, it gives us the value of lessee's interest in the property, which is 5.23 lakhs. Next example is a tenanted house is required to be repaired at a cost of rupees 1 lakh. The tenants ask the landlord to repair the house, investing his fund, and agree to pay the amount required for repairs without any obligation after 8 years. What amount will have to be deposited by tenants yearly in a bank if prevailing rate of interest was 9% for the recurring deposit? So here we had discussed the concept of sinking fund. So here we have to calculate the gross sinking fund. If you remember in the, I think chapter 8 part 1 and session 3, we had discussed the concept of gross sinking funds. If you remember if you have gone through the video, so from there you will get the concept. So this example is pertaining to calculation of gross sinking fund. Data given in this question is that sinking fund required after it is actually 8 years is 1 lakh rupees. Sinking fund period is 8 years. So accumulative ROI, we had discussed the concept of accumulative ROI in our last session, is 9%. So gross sinking fund is required. So ASF is annual sinking fund is formula we have already derived in our previous session. We have understood how to derive this formula and how to remember this formula and what is the logic for calculation this formula. So first we will calculate annual sinking fund, which is recoupment rate is IS, and based on that this is the ASF, and then we will multiply this ASF with sinking fund required, which is equal to 9,067 rupees 40 paisa. So annually the tenants are supposed to be deposit 9,061 rupees 40 paisa in a RD of rate of interest of 9%, so that after 8 years the landlord will get 1 lakh rupees for maintenance or repair of the building. Next example is a landlord owns a building which is fully rented to 9 tenants. Plot area is 600 square meter. Land is fully utilized in 3 floors of building. Rent is 1,800 per month. Remember, it is per month. property taxes 5,400 per year. I repeat, per year. NA tax 300 rupees per year. Insurance 600 rupees per year. Building is 80 years old. Tenants are protected by Rent Act. So this is important. So this type of question may come. We had discussed in last session the impact of Rent Control Act on the property, and this act we will discuss in our subsequent session on real estate laws, chapter number 7, which we will discuss in subsequent sessions. Repair may be taken as 10% of gross rent, and collection and management charges 4% of gross rent. Calculate value of the property, land plus building, assuming yield of 10%. So data given in this question is that number of tenants 9, fully tenanted, plot area 600 square meter, number of floors in building 3, monthly tenants, monthly rent 1,800 per month, property tax 5,400, NA tax 300, insurance cost 300 rupees per annum, age of the building 80, tenants are protected under Rent Act. It is important, it will affect overall valuation of the property. We will see how does it affect. Repair cost 10% of the gross rent, collection management charge is 4% of gross rent, yield is 10%, and property value we have to calculate. So again, you have to please pause your video and try to solve your numericals of your own. The solution is given on the next slide. We will also see some of the data given in the question is of no use and will not be required and has been given only just to confuse the IBBI aspirant. Since property is subject to Rent Control Act, the landlord will never get his land back. Thus, property has nil reversionary value. So the concept of reversionary value we have already discussed in previous sessions. The landlord shall get monthly rent of 1,800 rupees from each tenant perpetually. Right. So total value of the property value is capitalized value of the net perpetual rent from the property, and then net annual rent divided by yield. Let us see. This is the formula we have to use. So gross annual rent, monthly rent into 12 months. So monthly we are getting 1,800 rupees from the property, and 12 months are getting, so 21,600 rupees of rent we will get from the property on annual basis, less outgoing. So property tax we will deduct 5,400, NA tax, insurance cost, and repair of the gross repair is 10% of the gross receipt, which is 21,600. So 2,160 are for repairs. Then 4% collection and management charges. This again we will deduct. Accordingly, we will get net annual rent receivable, which is 21,600 minus all outgoings. So it will give us 12,276 rupees is the total annual rent receivable from the property divided by yield. It gives us the property value, which is 1.23 lakhs. Example 8. The landlord owns a property having 1,000 square meter land. It is fully let out to tenants for 3,600 rupees per month. Building is 10 years old, having 50 years of future life. Land is fully utilized. Property taxes are 6,000 rupees per year. NA tax is 700 rupees per year. Insurance is 900 rupees per year. Repairs at 5% of gross receipt. Collection management charges 4% of gross rent. Present rate of land is 800 rupees per square meter. Assume yield 7% and recuperate 5%. So now we will see the impact of TP Act on the property. Rent Act we have seen. So here again we will write the data from the question: land area, monthly rent, average age of the building, future life of the building, property taxes, NA taxes, insurance, repair, collection management, present land rate, yield, YC, capitalization rate, recoupment rate, IS, and property value you have to calculate. So please pause video here and try to solve it of your own. So since there is no mention of Rent Act in the question, please remember this thing and note down this thing. Transfer Property Act shall be applicable on the rented property to be valued. So thus both ejectment of tenants and increase of contractual rent are possible. Since Rent Act is not applicable, TP Act will be applicable on the property, and landlord can either eject the tenants and can also increase the contractual rent. Since remaining useful life of the building is 50 years, let's assume landlord shall earn rent from the property for next 50 years and will get back the land after 50 years. Right. So since remaining useful life of the building 50 years, so let us assume landlord will earn rent from the building for next 50 years and will capitalize that value. So property value shall be equal to from income approach, reversionary value of the land to be received after 50 years. After 50 years there will not be any value of building. So structural value of the building equal to capitalized value of net annual rent from the building for next 50 years. So whatever rent we are going to get from the building for next 50 years, which is the remaining useful life of the building, shall give us the structural value of the structure. So revisionary value we have already calculated. We have already understood the formula in previous sessions. First we calculate the present value of the land, which is 1000 square meter of land area into 800 square meter of rupees 800 per square meter of land rate. So it gives us a land value of 8 lakh rupees. Since landlord is able to sell this land after 50 years, so we will capitalize this value with a single capitalization rate of 7%, and we will the actual present value of the 8 lakh rupees of market value of land is 27,158, which is the revisionary value of the land. Capitalized value of the land, second part of the valuation, is net annual rent into year purchase dual rate. We have already calculated. In case of recoupment rate has been given, so we have to consider dual rate. So annual gross rent is monthly rent into 12 months, which is 3612. So annual gross rent is 43,200 rupees, as we have calculated in last question. Likewise, we will calculate net annual receivable rent in this question also. So gross annual rent minus outgoings. Property tax is 6,000 rupees, NA tax is 700 rupees, insurance cost 900 rupees, repairs 10% of GR, gross receipt, collection management charges as sorry, it is actually 5% of the gross receipt, and collection management charges as 5% or 4% of the gross receipt. So it gives us the total outgoings. These are the total outgoings. All these figures are in annual numbers. So 43,200 minus or total gross outgoings, it gives us net annual rent receivable of 31,712 rupees. So SFF sinking fund factor or annual sinking factor formula we have already discussed in previous session and previous question also. So with the help of recoupment rate, which is IS 0.05, we will calculate this thing for 50 years. 0.004777 is the IS, is the ASFF or ASFF. Then yield purchase for dual rate is 1 divided by capitalization rate plus SFF sinking fund factor, which gives us year purchase of 18.25. So structural value will be capitalized value of the rent, which is equal to net annual rent into yield purchase dual rate, which is 31,712 into 18.25, which gives us a value of 5,78,931. So total property value is revisionary value plus structural value. So it gives us value of 6,06,000 rupees in total. That is the answer. Next example is find NPV. We discussed the concept of NPV and IRR in last session. So let us see one or two examples for this thing. 1 mark question may come in the exam. Find NPV of the project having following data and advise the client. So cost of purchase is 1 crore rupees, 100 lakh rupees, improvement 75 lakh rupees, rent per year for consecutive 5 years, 15 lakh rupees per year rent will get, and sale price of the end of the 5 year is 2 crore 50 lakh rupees, and capital gain tax to be paid on the property after 5 years is 30 lakh rupees, and target rate, which is yield or expected ROI, expected rate of return, is 12%. So as data given in this question is that first we have to calculate in case of NPV and IRR. First bifurcate the data in the form of outflow and inflow. So outflow figures are 100 lakh rupees, 1 crore rupees is cost of purchase to be incurred at initial day, 0 year, and then 75 lakh rupees for cost of improvement at 0 year, and 30 lakh rupees of outflow will be there at the end of 5th year in the form of capital gain. And what are the inflows? 15 lakh rupees annual rent for next 5 years and 250 lakh rupees of sale proceed at the end of 5 years. So target rate, which is capitalization rate, is 12% and period is 9 years. So we have to calculate NPV of the project for decision making. So we know formula for NPV, which is capital value of inflow, all inflows, minus capital value of all outflows. So capital value of inflows is capital value of rent for 5 years plus capital value of sale proceeds of the land. So 5 years capitalized value of 5 year is annual rent into year purchase for 5 year, and then sale value, capitalized value of sale proceed divided by a single capitalization rate of 1 plus IC raised to power n. So this formula we will put up the figures of 12% in IC and n is equal to 5. So it gives us the value of the capital value of the total inflow, which is 195.93 lakhs. Likewise, we will also calculate capital value of outflow, cost of purchase, cost of improvement. These two expenses we are incurring at 0 period. So we need not to discount these figures. These are present values, and then capitalized value of capital gain. So since capital gain is required to be incurred, is required to be paid after 5 years, so we will calculate present value of this capital gain to be paid after 5 years by dividing it by 1 plus IC raised to power n. This formula we have discussed in previous sessions. So 30 divided by 1 plus 0.12 raised to power n, it gives us 17.02 lakhs equal to capitalized, which is equal to capitalized value of capital gain. So 175 plus 17.02 is equal to 192.02 lakh. Now we have values of total inflow, present value of total inflow, and present value of total outflow. So NPV is present value of total inflow, a capitalized value of total inflow minus present value or capitalized value of total outflow. It gives us a NPV of positive NPV of 3.91 lakh. As discussed in the last session, if NPV is positive, then it is a go ahead project. If NPV is negative, project is unacceptable. If NPV is 0, the project may be accepted or may not be accepted. Next question is pertaining to IRR. So let us try to calculate IRR for the project which was given in the previous example. So same data has been given and we'll try to calculate IRR of the project. So again, data given same. So for calculating IRR, there is a auto tool in Excel sheet which is called goal seek, and otherwise calculating IRR is very complicated. But here an approximate method has been given. Normally IRR calculation question doesn't come. However, if it comes, then this is the approximate method and you will get almost 99% near accurate answer out of this formula. So the formula for calculation of IRR is like hit and trial method. So first of all, you have to find out two ICs or capitalization rate or expected target rate on which two subsequent 1% gap IRR target rates. Say 12%. Here in case 12% we are getting positive NPV, and in case of target rate of 13% we are getting a negative NPV of 2.83. So these two IRRs, these two target rates we have to calculate through hit and trial method first of all, right? So once we get this data, that NPV gets changed from if we increase target rate from 12 to 13%, then NPV gets negative from positive, right? So this is the break-even point. So IRR will be somewhere in between 12 to 13%. So if you are having a question and you get an option which gives a single option between 12 to 13%, you need not to do further calculation and you can straightforward click on that answer. You will get the answer. However, if some close options are there, then you can use this formula. IRR is equal to IC, which is target rate lower, capitalization rate to target rate lower, which is 12% here, then NPV lower. What was the NPV for lower capitalization rate, which was 3.91, divided by NPV lower plus NPV upper. So NPV lower and NPV upper, ignoring sign, negative sign. So absolute figures we have to take and then sum total of these two figures and multiply by difference of these two gap between these two target rates or capitalization rates. So which is 1% here. So 12% plus 3.91 divided by 3.91 plus 2.83 into 13 minus 12%. So it gives us an IRR of 12.58%. So this is a very simple and easy and quick method. Otherwise, it is very difficult to calculate with a 100% accurate method in the exam, because we are not supposed to use scientific calculator in exams. Next example is pertaining to valuation of cinema and valuation of per seat of cinema, as we discussed in last session regarding profit method. So this is the question: calculate value of cinema and value of per seat for cinema with data. Full capacity of the cinema is 1175 seats. Full house income excluding entertainment tax and show is 1,75,000 rupees per show. So from each show the cinema can earn maximum 1.75 lakh rupees per show. Income from advertisements of this slide is 2 lakh rupees per month. Please note it is per month and it is per show. So monthly share of owner from gross income 50%. Staff salary 15% of owner share. Electricity, energy, stationery, repair, taxes, insurance, etc. expenses 35% of owner share. Assume 40% of vacancy per show and 4 daily show in entire year of 365 days and capitalization rate of 12%. So data given in this question is cinema, number of seats in the cinema hall, which is 1175. Full house income, cinema can earn maximum 1.75 lakh per show. Income from slide is 2 lakh rupees per month. Here it is per show, here it is per month. And then owner share in gross receipt is 50%. Whatever gross income will come out of cinema, 50% will go to owner. Staff salary 15% of the owner income. Other expenses, insurance, taxes, repair, electricity 35% of owner income. Average vacancy 40%, that means 60% occupancy will be there. Number of shows per day for 4 shows. Number of day in a year is 365, and capitalization rate IC to be assumed in this case is 12%, and we have to calculate value of cinema and value per seat for the cinema owner. So first we will calculate total number of shows in a year. 4 shows per day multiply by 365 days, it gives us 1460 shows in a year. Gross income from each show, since 40% vacancy is there, so that means 60% occupancy is there in the show. So 60% into full show revenue, which is 1,75,000, it gives us a maximum revenue of 1,05,000 rupees from each show, assuming 60% occupancy and 40% vacancy. Gross income from all shows in a year, 1460 shows into multiply by 1.05, it gives us 15 crore 33 lakh rupees of gross revenue. Income from slides 24 lakh rupees. Sorry. Annual gross income from cinema is equal to income from show plus income from slides, which is 15.57 crore. Then owner share is 50% of this income, that is 7.78 crore. Then salary expense 15% of the owner income and 35% of other expenses of owner share. Then net annual profit of the owner is 7 crore 78 lakh minus 3 crore 89 lakh rupees of outgoings expenses, that means net annual income of 389.25 lakhs. Then value of cinema is capitalized value of net annual profit, and net annual profit is 389.25 divided by capitalization rate, which is 0.12. it gives us the total value of the cinema, which is equal to 32 crore 43 lakh 75,000. So now we have got total value of the cinema for the owner. Now if we divided value of cinema by number of seats, we will get value of each seat for the owner, which is equal to 2.76 lakhs per seat. Now let us discuss some case studies also. This is a 12 marks case study which can come in the examination. Similar case studies can come. So here we'll see the calculation of lessor's interest, lessor's shares and depreciation, amount of the building, depreciated value of the building. Very good concepts we will try to understand, and we will also understand the concept of unearned increase in the land, certain important covenants which may be stipulated in the lease deed. So the question is that HSIDC has leased out industrial land at measuring 2800 square meter in 1976 by charging full premium at a rate of 500 rupees per square meter. So initial premium has been paid in 1976 at the rate of 500 rupees per square meter. Lease period was 90 years, renewable for further 90 year period. So 90 years plus 90 years. So it is kind of perpetual lease. Lease rent was fixed at rupees 1 year. So annually lessee has to pay 1 rupee annual rent to the ground rent to the lessor. So lease rent is very less. Annual ground rent is very less, minimal. Lessee constructs a factory building of built up area 950 square meter in 1976. So after taking that land from lessor, lessee constructed of his own a building which built up area of 950 square meter. Lease provides that in case of sale assignment, lessee shall pay 20% of unearned increase in land value to lessor. So as per lease agreement, there is a clause stipulated in case the lessor further subleases or sales or reassigns the land to somebody third person, then whatever unearned profit the lessee will earn, 20% of that will go to the head lessor or original lessor. Replacement cost of the factory in 2015 is 16,000 rupees per square meter. Land value in 2015 is 6,000 rupees per square meter. Assume life of the factory building 60 years. Salvage 10% and use SLM method for depreciation. Calculate value of lessor right in 2015, value of lessee's right in 2015, lessor's share in property, lessee's share in property in 2015, depreciation amount of the building and depreciated value of the building. So depreciation amount and depreciated building, these are commonly used terminology and confusing terminology. So normally these two questions come in the exam in case study just to confuse the IBBI exam aspirants. So here data given in the question is that land area, initial rent premium 500 rupees per square meter, lease period it has been given, then lease rent is given, built up area, unearned profit loss 20%, replacement cost 2015 has been given, land rate 2015 has been given, life of building 60 years, salvage is given, and these 6 things we have to calculate. Please pause video here and try to solve it of your own. Solution is given on next slides. Lessor interest, right to reversion of land. The lessor in this case have three interests. If you remember last session, we had discussed lessor can have 3 type of interest in a leasehold property. Right of reversion. So here the land has been given on perpetual lease for 90 years, and then again 90 years renewal clause is there, so it is considered to be a perpetual lease. So lessor will not be able to get it back from the lessee under any circumstance, so it will have negligible reversionary value of the land for lessee, so we can presume it as a 0. Right, then capitalized value of lease rent. Since here the lessee is supposed to pay only 1 rupee per annum, so annual ground rent is very low, so it is very minimal. So again, capitalized value of annual ground rent will be negligible, so we can safely assume it as 0. Then next is right to waive a restrictive condition. This concept we discussed in the last session. In case of sale of assignment, 20% of unearned profit of land will go to the lessor. Thus, lessor right shall be restricted to 20% of unearned profit from the land value. So here lessor's interest will be equal to the 20% of the unearned increase of the land area. So first we will calculate land premium. Land premium was land area and initial premium which was paid in 1976. So 2800 square meter into 500 rupees per square meter was paid in 1976. So total 14 lakh rupees of premium was paid by lessee in 1976. So it was the initial land premium. Now land value in 2015 is land area and land rate 2015. So present land rate is 6,000 rupees per square meter. Land area will remain same. So existing value of the land is 1 crore 68 lakhs. So unearned profit in 2015 is land value, current land value minus land premium paid in 1976. So land value 2015 is 168 and land premium already paid is 14 lakh. So unearned profit is 1 crore 54 lakhs in this case, and lessor share is 20%. So lessor's interest in the property is 20% of 154 lakhs, which is equal to 30 lakh 80,000 rupees. This is answer number 1. Lessee's interest, it is part interest in the land because some portion of the land will go to the lessor and full interest in the building. So lessee's interest in the land is equal to total land value in 2015 minus lesser interest. So 168 in previous slide we had calculated 168 lakh rupees of total land value minus lesser interest. So it gives us lessee's interest in the land which is equal to 137 lakh 0.20 lakhs. So lessee's interest in the building is depreciated replacement cost of the building. We had discussed this definition in first session, chapter number 8, part 1, session 1. Right. So we will calculate in this particular case how to calculate the depreciated RCN. So replacement cost new of the building. Built up area is given. Replacement cost 2015 is given. So if we construct this building at a new cost, so it will give us the 950 square meter into 16,000 rupees per square meter. Replacement cost new of the building of the factory shed is 1 crore 52 lakh rupees. So since SLM method is mentioned in the case and salvage 10% is given, so first we will calculate percentage depreciation for 39 years. So now building was constructed in 1976. Now we have to calculate depreciated value of the building as of 2015. So percentage depreciation in the property will be 100% minus salvage divided by total life of the building, which is 60 years given in the question, and existing age of the building is 2015 minus 1976. So it is a 39 years old building. So 90 divided by 60 into 39, it gives us depreciation of 58.50. So depreciation amount, percentage depreciation into RCN 152. So this is the amount of depreciation. Depreciation is 88.92 lakh rupees. This is answer number 5. And depreciated replacement cost new or value is equal to total RCN replacement cost new minus depreciation amount. So it gives us depreciated RCN of 63.08 lakh, which is answer number 6. So now lessee's interest. Lessee's interest is part interest in the land and full interest in the building. So lessee share in the land was 137.20. We calculated in previous slide, and depreciated value of the building, depreciated RCN, replacement cost new of the building is 63 lakhs. So total value, total lessee's interest is 2 crore 200 lakhs 0.02 lakhs. So lesser share, lesser interest divided by total property value. What is total property value? Total land value plus depreciation RCN. So total land value was lessee's interest in land plus lessor interest in land. So 168 plus 63.02 depreciated replacement cost of the building. So this is total value. So this gives a 13.38% is lessor share in total property value, and lessee share 100% share minus lessor share. This gives us 86.67% of lessee share in the property value. Answer number 6. Next case study is, in 1965, Mr. X leased out land at measuring 2500 square meter for a period of 70 years with annual lease rent of ₹3,000. It is annual lease rent. Lessee constructed a residential building and rented out them to tenants against annual rent of ₹50,000 again. So Mr. X took up a piece of land on ₹3,000 of annual ground rent for 70 years, and area of the land was 2500 square meter, and further he constructed a residential building on it and started getting a house rent of ₹50,000 per annum from the building. As per lease agreement terms, on maturity of lease, building will vest with lessor free of cost. So after maturity of lease, the building will automatically go to the lessor. Rent Control Act is applicable on tenants in the building but not on lessee. So it is important. So here three parties are involved. On one party, lessee Rent Control Act is applicable. On another party, the main lessee, Rent Control Act is not applicable. Assume yield of 8%, recoup rate of 4%, calculate lessor interest in 2010 and lessee interest in 2010. So again, data given in the question is that land area it is given, total lease period is given 70 years with effect from 1965. So remaining lease period we can calculate. It is important term. So 70 years is total lease period minus 2010 we have to calculate the data, and 1965 was the commencement of the lease period. So 25 years is the remaining lease period of the lease. Remaining period of the lease. Annual ground rent is already given, ₹3,000 per annum. Annual house rent, gross house rent is ₹50,000. On maturity of lease, building will pass on to the lessor without any cost. It is important fact. Then Rent Control Act is applicable on tenants in the building but not on lessee. So tenants who are paying ₹50,000 of rent, it is a Rent Control Act is applicable on them, but it is not applicable on lessee who is paying ₹3,000 of ground rent. So capitalization rate is 8%, recoupment rate is 4%. Lessor right and lessee right we have to calculate. So lessor has the following two interest in the property. So lessor will receive ground rent of ₹3,000 per annum for next 25 years. Since after 25 years, lessee will come out of the picture. However, the tenants who are staying in the property, they shall continue because Rent Control Act is applicable. The property cannot be evicted, right, after expiry of lease period. So after that, the lessor will start getting annual rent of 50,000, annual house rent of ₹50,000 from the tenants directly. So accordingly we will calculate right of these things. And lessee will have lessee's rights include right to receive house rent for ₹50,000 per annum for next 25 years. So first we will calculate capitalization value of ground rent for 25 years which lessor is going to get. So year purchase, first we will calculate year purchase for 25 years assuming capitalization rate as given in the question of 8% and for 25 years, right? So 10.67 is year purchase. So annual ground rent for capitalized value of ground rent for the lessor is 5,000 into 10.67. So it gives us the capitalization value of the ground rent for the lessor. So next we'll try to calculate perpetual house rent that lessor will get after expiry of 25 years because tenants cannot be evicted because of application of Rent Control Act on the tenants. So after 25 years, which is from 2010, that is after, with effect from 2035, the lessor will get annual rent of ₹50,000 from tenant. So IC, which is capitalization rate, is given as 8%. So capitalization value of the future rent, perpetual rent from the property as of 2035 will be equal to annual house rent divided by IC, which is ₹50,000 divided by 0.08. It gives 6.25 lakh. So this value is the capitalized value is as of 2035. Now we have to discount it to present value to 2010, which gives us capital value of 2035 divided by 1 plus IC raised to our n. So that is a formula for capitalizing present value. So 6,25,000 rupees we will receive in 2035. So present value of that 6.25 rupees which we are likely to receive in 2035 is 91,261. So lesser interest is capitalized value 2010 of ground rent and capitalized value 2010 of perpetual house rent, which we are going to receive after expiry of lease period 25 years, is one total amount or total value of lesser interest is 144.611 is answer 1. Lessee's interest. So first we will calculate the profit rent. So house rent is 50,000 rupees and ground rent he is paying 3,000 rupees. So net profit rent to the lessee is 47,000. So this 47,000 of rent the lessee will receive for next 25 years. So first we will calculate the SFF, sinking fund factor, or annual sinking fund formula we have already discussed in the previous session. Since recoupment rate is given as 4% and 25 years of period is there, so SFF is equal to 0.0024. Then we will calculate year purchase dual rate. All logics have been discussed in previous sessions. Please go through those video PPTs, how to calculate these formulas and how to derive these formulas. Then YP dual rate is 1 divided by capitalization rate plus SFF. It gives us yield purchase of 9.6164. So value of lessee's interest is equal to profit rent into yield purchase dual rate, which is 47,000 into 9.164. It gives us answer of lessee's interest equal to 4,30,708 rupees. That is answer number 2. So that's all for today's session. Thank you very much for watching this video. It was a lengthy session in fact. So before I'll tell you about the next session what we are going to discuss. So till now we have completed theory of 17 marks and I suppose at least 8 to 12 marks of numericals may come out of these sessions. So put together we have covered almost 20 to 30 marks of IBBI syllabus in sessions covered till now. So before I'll tell you about next session, what we are going to discuss in next session, I would request you to please subscribe to the channel and click on bell icon so that you will be immediately notified about the next video PPT as soon as I upload the PPT on YouTube channel. So next session we are going to discuss about market approach to value. So we'll try to bifurcate this session into multiple sessions because it is going to be a long chapter and a little bit difficult also, complicated chapter. So we'll try to understand these concepts with the help of examples also. So till then keep learning and thank you very much for watching the video. Thank you.